Good evening, friends. Welcome to the BISP Solutions. This is Raj Bhatt, and today, over the next 45 minutes, we will explore that the account dimension is why it is crucial for your planning and budgeting, and how its key properties work in the Oracle PBCS application. We will finish with a live demo to tie it all together. So first, we need to understand that what is account dimension. Yesterday we have covered these all the things. Yesterday we have discussed the planning aspects property. We have just talked about the data storage, consolidation, operator, two pass calculations, time balance properties, variance reporting, as well as we have seen that how the dimensions are bifurcated to two types of part, that is a sparse and the dense dimension. So yesterday we have just correctly got to know that how the sparse dimension is different from the dense dimension. What is the dichotomy between both of them? So as we know that sparse dimension has the few members with the data value, and as far dense as concerned, so it has many members with the data values. So it's a small and the little bit difference that we have to keep in mind to operate the instance in a better way as well as in the better manner, so that all planning and forecasting would be do smoothly by the professionals. So we will understand the dimension. Yesterday we have understand the dimensions type, even we have discussed, but we will also do the recap of it again. So let's start with the foundational concept, that is dimensions. So in Oracle PBCS, a dimension is a business category that organizes and stores your data. Think of them as the who, what, when and where of your financial information. For example, the period dimension tells you when a transaction occurred. The entity dimension tells you where it happened, and the scenario dimension tells you what type of data it is. So if I talk about its analogy, so imagine a spreadsheet with columns and rows. The columns are your dimensions. Each one is a category like months, products, or departments. The points where they intersect is a single data point like the sales revenue for a specific product in a particular month. So as far account dimension as concerned, so today we are going to focusing on one of the most important dimension, that is account dimension. This dimension represents your chart of accounts. It defines what you are planning for, and is it a revenue, an expense, an asset, or a liability. So it is the core of your financial data model. So let's have a look on its importance, that why it is important in instance, and why we use the dimension to forecast, to plan our financial structure. So the main and the major thing is the foundation of your data. Why is this dimension is so important? Because it's the foundation of your entire planning and budgeting process. Without it, your numbers would be meaningless. It structures your financial data in a logical hierarchy way. The second and most significant thing is hierarchies and the aggregation. The account dimension is a hierarchy. This means it's organized like a family tree. Like for example, total revenue is a parent member, and the children might be product sale and the service revenue. So this hierarchical structure is essential because it allows for automatic aggregation. When you enter data at the child level, suppose let's say product sales, so the PBCS automatically adds the number up to the parent level, that is total revenue. So this will saves you from having a manually calculate totals and ensures accuracy. Now we will understand what are the different types of account. So account are not all the same. PBCS categorizes them into different accounts types, and each types behaves differently. So we have the different several accounts like revenue, assets, expense, liability and equity, saved assumptions, and many more. So these are the main things that we will discuss today. that what are the type of accounts and how it will looks like and how it will impact the instance. So first let's see what is different account types. Different account types. So first one is revenue. We have total 5 type of accounts. So first one is revenue. So it aggregates as a positive number. The second thing that we have, it is expense. It aggregates as a positive number, but it usually displayed with a negative sign in reports to show its impact on profit. Then we have the asset. So it aggregates as a positive number. Another thing that we have is liability and equality, that is equity. Then we have saved assumptions. So these are the accounts that we have. Again, we can understand it. So what is revenue? So revenue aggregate as a positive numbers. And if I talk about the expenses, so it aggregate as a positive number, but it usually displayed with a negative sign in reports to show its impact on profit. Then we have the asset. So it aggregates as a positive number also. And now we will come to the liability and equity. So it also aggregate the same thing, that is the positive number. After that we have the saved assumption, used for accounts that store data used in the calculations like sales quote and percentage. So what is the importance of the proper setup? Why proper setup is important? So getting the account dimension right is crucial. An improperly structured hierarchy or incorrect accounts types can lead to inaccurate reports and failed calculation. Is the first place you should look when troubleshooting financial numbers in PBCS. Now we will see some key accounts dimension and its properties. A normal overview we will think, and we will just take it to the professional level. Earlier we have also discussed the same thing, but it would be a revision kind of thing for you if we will just repeat it again. So yesterday I have just mentioned its property, but again I will tell you about it. Very important, it cannot be neglected in the instance. So first one is data storage. So data storage, this property tells PBCS how to handle data at a specific number. So we have different options under it, like store data, dynamic calc and store, never share, and the label only. So for the base level members, where you directly input or load data, think of a specific line item like electricity expense. So I have given you the example electricity expense. So it will store the data for it. So that's why we will just keep it as an store. For the dynamic calc as concerns, so for parent label members, The value is calculated on the fly when you run a report. This is the great for performance because PVCS is not constantly pre-calculating and storing every total. Like for example, we can say that total expense would be dynamic calc member summing up all its children in a real time. Then we also have the never share property. So what we will do about it? It is used for members that should not be included in a total, such as comments or the text. Then we have the examples, like let's use our expenses example, like electricity, water and internet would all be store members. The parent utilities would be dynamic calc member and summing up the children to give you a real time total. Then here you can see the time balance property we also have. So this properties defines how data is handled across different period. So this is key for balance sheet accounts. Under this we have the flow and the balance sheet ones things. Like the values for the current period is added to the value from the previous period. This is default for most income statement accounts like revenue or expenses. After that we have the balance thing. So the value is the closing balance of the prior period. So this is essential for balance sheets accounts like cash or accounts receivable, where the ending balance of period becomes the beginning of the balance of the next year. Like you can take the example, like if you have $100 in revenue in January and $200 in February, the flow value for the February would be 300. But if you have 100 in cash at the end of January and 200 in cash at the end of February, the balance value for February is just like $200. In the earlier sessions we have discussed the difference between flow as well as the balance. So it doesn't add the months together. So that is the difference between flow and the balance. That flow added the aggregates, it contributes to the aggregates and it add the previous numbers, but in balance it takes the last year month. Another thing that we have, it is variance reporting. So this property tells PBS how to calculate the variance between two scenarios like budget and actuals. So in expense, like subtract the budgeted amount from the actual amount, actual minus budget. And for the non-expense we subtract the actual amount from budget amount, like budget minus actual. So here I can mention it. Here we will take actuals minus budget, and under this one we will have budget minus actual, budget minus actual. So this is the difference. Like for example, for an expense account, if your budget was $100 and you spent $120, the variance would be $20, indicating you were over budget. For a revenue account, if you budgeted $100 but made $120, the variance would be $20, indicating you were over the budget. So it's a simple thing, like, but a powerful way to ensure your variance reports make business sense. So this is how it works and how it takes the different things into different dimensions. So we have discussed the amount as well as the different account dimensions type, and the different account types, that is revenue, expense, asset, liability, saved assumptions, and the equity ones. Even we have also taken the properties of it, like data storage, consolidation operator, even two pass calculation. So two pass calculation is the very important thing. I can mark it with it, very important segment. So it ensures that a member formula is evaluated after the first pass of the calculation. So we have to keep in mind that what two pass calculation we will implement under the instance while using this. So then we have the time balance property, very important. We have to select uh, or the members property very wisely, because one mistake can absolutely ruined your all the financial structure. It is also important to have time balance, so it is flow and balance. So flow is about the aggregation. So flow is about the aggregation. So we are aggregating the things. Aggregating. Aggregation. Then balance is about your, the value is the closing balance of the prior period. So this is essential for balance sheet accounts. Ending balance of one period, that is ending period of of one period of one period. So this is how it works. So you have taken the difference, you have seen it, what is various reporting, time balance properties, even sparse dimension. These all are the beautiful things that we have seen in the instance, very important things, very significant. It plays a vital role in the planning and forecasting of financial structure. So we cannot neglect these all things. We have to keep it in mind, very important, while making the changes as well as selecting the members and the members properties, so that all the things would go in a better manner and in the smooth way. So this is how professionals do their work. They do their all analysis within the instance. So thank you for your time today. I hope